Welcome to the Deep Dive. We're the place you come to cut through all the noise from earnings calls and get straight to the essential insights.
Yeah, we do the digging so you don't have to.
Exactly. And today we are taking a close look at Saratoga Investment Corp, that's ticker SAR, specifically their fiscal first quarter 2026 financial results.
Our goal here is really simple. Unpack the key takeaways from their call, get you up to speed fast on what actually matters.
It's definitely an interesting picture. Saratoga's navigating a pretty dynamic market right now.
For sure. So we'll kick off with the headline numbers, give you that snapshot.
Right.
And then we'll dig into the why behind them, the strategies and management thinking.
Perfect. Let's jump right in then. Results snapshot. Saratoga recorded adjusted net investment income NII per share of 66 cents. That's for the quarter ending May 31st, 2025.
And that 66 cents, that's up a pretty substantial 17.9% from the previous quarter. Quite a jump.
It really is. And it wasn't just NII growth either. Their net asset value, the NAV, kept climbing too. Yeah,
it hit $396.4 million. That's up 0.9% just from last quarter. And maybe more impressively, up 7.8% over the year. Solid growth there.
And this number really caught my eye. Their latest 12-month return on equity is sitting at 9.3%.
Wow, that's strong. Especially when you compare it to the wider BDC industry. What's the average again?
Around 7%. So yeah, Saratoga's significantly outperforming there. They also announced their dividend. It's a base dividend of 25 cents per share per month. So that totals 75 cents for the second quarter of fiscal 26.
And based on the stock price back on July 7th, that translates to an 11.8% yield. Pretty attractive yield.
Definitely. But, yield isn't everything. Credit quality is crucial.
Absolutely critical. And that's another standout area for Saratoga. Their non-accrual rate, basically.
Yeah.
The loans not paying is incredibly low, just 0.6% of costs.
0.6%? That's tiny.
It really is, especially when you think the broader BDC industry average is 3.7%. It just highlights their discipline,
Big difference. Now, there is one little wrinkle with the NAV per share this quarter. It actually dipped slightly to $25.52.
Right. But you really need to understand the why behind that dip. It wasn't about underlying portfolio value dropping.
No, exactly. It was largely a one-time hit, about 50 cents per share, because they transitioned to monthly dividends.
Yeah, so two dividend record dates just happened to fall into the same reporting quarter. It's a timing thing.
Right. If you actually adjust for that, exclude that one-time event, the NAV per share would have gone up to $26.02.
Which is a 0.6% increase. So the underlying value is still growing. That's the key takeaway there, despite the headline number.
Good context. It shows confidence, prioritizing getting cash back to shareholders monthly.
Definitely. Okay, so those are the headlines. Let's dig a bit deeper now.
Yeah, let's understand the drivers. That big sequential jump in adjusted NII, the 17.9% increase, where did that come from?
Well, the primary reason was simply that a $2.4 million annual excise tax they paid in the prior quarter didn't repeat. So it's more about a cost not recurring than a massive operational surge.
Ah, okay. But looking year over year, NII was actually down slightly.
It was, yeah. And that was mainly due to, a couple of things. Lower assets under management, or AUM, because they had some significant repayments recently.
Right. Borrowers paying back loans.
Exactly. And also just the general trend of short-term interest rates starting to tick down a bit, which impacts floating rate loans.
Makes sense. But even with those factors, their net interest margin looked pretty healthy.
It did. It actually expanded quite nicely from $13.7 million last quarter up to $15.6 million this quarter.
So how did they manage that?
Mostly from getting the full benefit of investments they made in the previous quarter kicking in.
Okay.
And also lower interest expense because they paid down some of their own debt recently. Smart balance sheet management, basically.
Yeah, optimizing things. And speaking of the balance sheet, they ended the quarter with a lot of cash.
A lot of cash. $224 million. Just sitting there, ready to be deployed.
Ready for new investments or maybe paying down more debt.
And that's just the cash on hand. Their total investment capacity, what people call dry powder, is even bigger. It's an impressive $430.3 million.
Wow. Where does all that capacity come from?
So there's the cash, obviously. Then they've got $136 million available from their new SBIC3 license.
Right. The government-backed leverage for small business lending.
Exactly. And another $70 million available on their revolving credit facilities. So plenty of firepower.
Which brings us back to credit quality. With all that potential money to put to work, are they maintaining standards?
Seems like it. The overall quality looks really steady, really strong. 99.7% of their loans are rated in the highest category.
Almost perfect.
pretty close. And remember those two investments that were on non-accrual, Zoology and Pepper Palace?
Yeah.
Both have been successfully restructured. And Zoology actually showed a $1.1 million increase in value this quarter. So they're actively managing and turning things around.
That's proactive management right there. Good to see. And the portfolio structure itself, still conservative.
Very much so. Total AUM is $968.3 million, spread across 46 companies. And the key stat, 86.9% of that is in first-lien debt.
Meaning they're first in line to get paid back if something goes wrong. That's a good safety net for investors.
Definitely. But they aren't only doing debt, they do have equity interests too, about 7.9% of the portfolio.
And is that contributing?
It is.
Yeah.
It added $2.9 million in realized gains this quarter, and $2.2 million of that was from selling one equity position.
Okay.
And historically, this equity piece has been pretty lucrative for them. Over the last 13 years or so, they've generated $42.5 million in net realized gains just from selling equity stakes. It's a nice kicker to their returns.
Okay, so that's the financial picture. What's management saying about the market environment and their strategy going forward?
Well, they're acknowledging things have slowed down a bit, particularly in the lower middle market deal volume, M&A activity.
Seeing that across the board, really.
Yeah. They mentioned things like tariff developments, less new debt being issued overall, and also there's just a lot of capital chasing deals right now.
Right, which pushes spreads tighter, makes it harder to find good value.
Exactly. It's challenging to find quality new platform investments at the right price.
So how are they responding? Are they lowering their standards to compete?
Absolutely not, according to them. They were pretty emphatic about maintaining their disciplined approach to picking assets.
Sticking to their knitting.
Pretty much. They highlighted their historical returns. That core non-CLO portfolio has generated unlevered realized returns of around 15%. They're not willing to compromise on quality or take on undue risk just to grow AUM.
Which in this kind of environment is probably what you want to hear as an investor.
I would think so.
Yeah.
But they're not just sitting back passively. They're actively trying to counter the slow market.
How so?
They're significantly boosting their business development efforts, investing in people. They've hired a new managing director, a VP of portfolio management, a BD analyst, 2 new investment associates.
Putting resources into sourcing deals.
Exactly. And they say it's already starting to pay off. They mentioned seeing 18 term sheets from new relationships in the past year. So that investment seems to be generating pipeline.
Interesting. And they still seem very focused on that lower middle market space.
Very much so. They firmly believe it offers the best risk-adjusted returns.
Why is that?
They listed a few reasons: better ability to do deep due diligence, more conservative capital structures usually, stronger legal protections, and more ability to actually get involved and help manage the companies if needed, more hands-on potential.
Makes sense. They feel they have more control and insight there.
Right. But they're also looking at new avenues. They talked about a new opportunity they're exploring.
Oh, what's that?
Investing in CLO debt securities, specifically the BB and BBB rated tranches.
Okay, so CLOs, collateralized loan obligations, bundles of loans.
Yeah.
And they're targeting those mid-level risk slices.
Yeah, BB and BBB. The idea is to get potentially enhanced yields compared to safer assets, but with default rates that have historically been quite low for those ratings.
So leveraging their expertise in the loan market, but in a different way.
Exactly. They've been in the CLO market for a long time as managers, so they feel they know how to pick good managers and structures. They've already put about $13 million to work across 9 different CLO securities from 7 managers this quarter.
An interesting diversification strategy.
Yeah, a way to potentially deploy capital effectively while the traditional M&A market is slower.
And underlying all this is their balance sheet management. They seem pretty focused on liquidity.
Very focused. They highlighted their strength there, the flexibility it gives them, especially with some debt maturities coming up down the line. They want to optimize how they use cash versus other financing.
Right, not just hoard cash, but use it smartly alongside debt options.
And they mentioned strategically upsizing their Live Oak credit facility too, just to ensure they have that long-term flexibility locked in.
And one more point on alignment management owns a decent chunk of the company, right?
They do. 11.1%. That's a significant personal stake, which usually means their interests are pretty well aligned with shareholders. You know, they have skin in the game.
Definitely. And you can't argue with the long-term track record.
No, you really can't. Total return over the last 12 months was 22%. The BDC index, just 3%.
Huge outperformance.
And long-term, since this management team took over back in 2010, their total return is 826%. The industry average over that same period, 294%.
Wow. Okay. That puts things in perspective.
It really does. Consistent, significant outperformance over a long period.
All right. So let's bring it all together. What does this mean for you, the listener, the potential investor?
Well, I think this deep dive shows a company that's navigating a tricky environment pretty strategically. They've got a clear plan.
Yeah. And even though AUM dipped because of those loan repayments, they're clearly prioritizing credit quality over just chasing growth.
Which is probably the right move in a volatile market, right? Focus on resilience, protecting the portfolio. That's a key signal for you.
And that huge liquidity position, that dry powder.
Means they're really well positioned. They could be patient, wait for the right deals, or strategically deploy capital into things like those CLO securities they mentioned. They're not forced to act, but they can act when opportunities arise.
Right. Expanding the BD team, exploring CLOs, those are forward-looking moves. Planting seeds for future growth, even if M&A stays slow for a bit.
Mm-hmm. And you combine that with the strong dividend, the high ROE, the top-tier credit quality. It really paints a picture of a company focused on delivering consistent value back to you.
Even if NII is slightly under the dividend right now, using some spillover income, the overall story seems solid.
Agreed. Disciplined, proactive, seems effective.
Okay. Now for the fun part, let's put on our slightly outrageous analyst hats for a second. This is purely speculative, definitely not financial advice.
Right, big disclaimer there, just brainstorming.
So Saratoga's sitting on that $224 million in cash, earning maybe 4% or so, way less than their deployed assets are yielding.
Mm-hmm. Big pile of relatively low earning cash.
And their NII, 66 cents, is just under the 75-cent quarterly dividend. Plus, management keeps saying, discipline, discipline, we won't chase bad deals.
Okay, setting the stage.
So here's the wild thought. What if they did a strategic one-time special cash dividend? Use a chunk of that excess cash pile.
Instead of just waiting for deals that might take time to materialize.
Exactly. It would return capital immediately to shareholders. It would signal massive confidence in the balance sheet and their commitment to shareholder value, even when deployment is tough.
It leverages that liquidity, shows they're thinking proactively about capital allocation beyond just originating loans. Kind of bold.
Yeah, kind of we don't need to hoard this cash. We'll give some back move. Dares to be different from peers just obsessed with growing AUM at any cost.
Yeah.
Optimize returns now in an uncertain market.
It's definitely provocative.
Yeah.
Highlights their financial flexibility and options, that's for sure. A very interesting thought experiment.
Food for thought anyway. So let's quickly recap our deep dive.
Okay. Saratoga Investment Corp. Strong quarter overall, significant NII growth sequentially, mainly due to that tax non-recurrence, but still solid.
Robust NAV growth if you adjust for the dividend timing quirk. Great return on equity, exceptional credit quality.
All while navigating a, let's face it, pretty tough deal environment.
Their strategy seems clear. Disciplined asset selection, investing in business development for future growth, and exploring new avenues like CLO debt.
Positioning themselves, it seems, for long-term growth and continued shareholder value.
We definitely encourage you to think about how Saratoga's strong balance sheet and their strategic moves might fit into your own investment outlook.
Lots to consider there.
Absolutely. Well, that's our deep dive for today. Thanks for joining us.
Yeah, thanks for listening. We look forward to speaking with you again next quarter.